Well, if you were currently holding shares of Fannie Mae, the poor person that was holding those shares has actually lost all of that value if you didn't get out and sell. But the person that bought insurance or the put option absolutely cleaned up. You can see there, just in a matter of a few months when that stock fell, yes, our investment was $4,000 by buying this insurance policy. We didn't own the stock, but we could go out and profit from the fall without owning the stock by buying a put option, buying the right to put this stock back to the market at $40 a share. It falls all the way to 40 cents. Hang on, we have the right now to sell it at $40. So the difference between where we have the right to sell it at and where it's trading is our profit. $4,000 into $40,000 just in a matter of, that was in a matter of 4 months, just by using options. You see, options is a way of getting really creative with the stock market. You've just really got to know how to use them. And of course, the brother company, Freddie Mac, did exactly the same thing. Fell down there to 20 cents a share. Another $4,000 invested turned us $40,000. So now you start to see that you can trade not only the upside of the market, but you can trade the downside of the market as well. Bear Stearns, remember when all these financial companies collapsed last year? This was a time to get in and buy these put options on all of these companies. When Citigroup collapsed, now I'm going to show you now this amazing super fund strategy that your fund manager doesn't know how to do and can't do. And this is why now, since the crash, the financial crash, and everybody has lost how much of their super funds now? They've lost over half of their values due to leaving it to somebody else. Now Australians more than ever now are starting to realise that we need education, to educate ourselves, to take control now of our own money and invest it ourselves. Citigroup was a falling, collapsing company that actually fell down there to $1 a share. Citigroup at the moment, you can see on the bottom of the chart how it's virtually going sideways, doing nothing, isn't it? There's an interesting story with Citigroup when you understand what happened with Citigroup collapsing. Instead of going bankrupt, and they were on the verge of bankruptcy, the Fed stepped in and nationalised Citigroup. Now, it means a couple of things to us as traders. It means that, okay, Citigroup now can't go bankrupt, but it also means that the Federal Reserve has nationalised Citigroup. Very importantly to understand that. So if we know that there's no growth now in this company for a long, long time because they've got a massive lot of debt, foreclosures on their books that they need to get rid of, and that's going to take quite a few years to do that. But while this stock, and it reminds me a little bit about our company here in Australia, Telstra. Telstra is one of those stocks that I call a dog with fleas because it's a lot of mums and dads own Telstra in their super funds and it's doing nothing. It has never made them a profit. But because Telstra is optionable, it has one beautiful strategy you can trade with it, and that is you can sell those options now and take in some rent money. Citigroup's one of those companies now in the US that I actually own, even though it's a dog with fleas, but Citigroup now is returning me 5% a month income from these shares. This particular strategy now with these options, instead of buying these options, now we use a different strategy and we sell these options. You see, when we sell a call option, we are selling the right now to sell our stock at a set price. It's very much like it's a rental strategy. It's the same as real estate. You know how we go out there and we buy a house and we put tenants in to pay that rent every single month? Well, did you know you can go out there in the stock market and buy shares and rent those shares out every single month and the market will pay you? So to give you an analogy how this works, Citigroup's trading at $5 a share. So we go out there and we buy 1,000 shares of Citigroup. we spend $5,000. Then we turn around and sell the $5 call option against Citigroup, and the market will pay us 25 cents. On 1,000 shares, that's $250. So on our investment of $5,000, we've just been paid $250 for that month. Now, if Citigroup, on expiration, these options expire every single month on the third Friday of every single month. So come the third Friday of October, if Citigroup closes above $5, guess what? They will pay us $5 per share, give us our money back for those shares. We don't care because we've just received $250. And it's called exercising our stock. They take our stock off us. So let them have the stock, because we go back in later on and rebuy the shares back again and resell the option again. If on the third Friday Citigroup closes below $5, we get to keep our stock. They won't take it from us. It is now freed up to go out and sell now the November $5 call option, and we get paid now another 25 cents. So the way I liken it is, where can you go out and buy? It's an investment vehicle that is now making you monthly income. Where can you go out and buy a house for $5,000 and rent it out at $250 a month? Maybe in America very soon, when you see the damage that's happened over there. This is another beautiful rolling stock. It's a gold stock, of course, so you can see that we're doing a lot of these strategies in the gold sector. This stock is rolling between basically $9 and $12, and it does its whole lifespan. You see, stocks trade in predictable patterns between what we call support and resistance. It's a little bit like if we have real estate, it's a little bit like watching our real estate as we own it fluctuate up and down as prices pull back in real estate. We find our houses weren't worth as much as what they were maybe 6 months ago. Stocks do the same thing where they roll. They make perfect candidates for little rental stocks to rent these shares out in the market. This little one alone is paying roughly, remember this is an $11 stock, so a little bit more expensive. It's going to pay a little bit more rent than Citigroup. So it all comes down, doesn't it, to understanding strategies in the market. Now, who wished that their super fund manager was doing that kind of strategy in our accounts? Because if they have been doing that and having insurance as well to protect the crash, do you think Australians would have lost so much money? They wouldn't have. So you get to really understand that a fund manager, he's only interested in his 1 or 2% fee that he gets paid off your capital. He's not really interested in exactly where that's going to get invested. And there's no protection strategies there, because I know, you know, when the fund managers they got hit last year with so many people ringing them up and complaining about, you know, but my fund's losing so much money. Their standard answer was, well, everybody's losing money. Well, do you want to be everybody and stay in that same... Does that make you feel any better? I don't want to be everybody. So now it really has woken up to Australians to really now take control of their own finances and do it for yourself. On this chart here, I'm going to go back and show you exactly what has happened with the crash that we had last year. If we go back to the crash of 1929, and this is where there's very strong similarities between 1929 and now. Remember back in 1929, when the market came crashing down here, when a market falls, it's got to give some back and rally. And you're going to see the same likenesses right here and now with what is happening in the US market, since the Fed has stepped in and printed all this money. Since March this year, the market has been rallying, and a lot of people think that, hey, the crisis is over, when in reality, the crisis has only just begun.